Hi guys, welcome back. Trade Hour, and in today, which is currently the 29th of July, we're currently trading the Nasdaq. We've had a few nice runners, but what I want to talk about today is lows, and what they mean for us guys, right? So what I'd advise everyone to do is make a note of your highs and make a note of your lows. Okay, so what we want to highlight here is a point of interest. What I want you guys to look out for is how many times we want to hit the highs and how many times we want to hit the lows. So for instance, we came from 29th, which was 12:50 UK time. Well, I think it was 11:50. Anyway, we hit high. We then wanted to go back to this high, which we kind of did, but obviously the wick closed out. And then we did it once more. And then what happened was we then made a new low for the day. And then we then made a new low again. So we did 2 lows, we did 3 highs. So what is price wanting to do after we make these highs and make these lows? Well, price is wanting to get back up to these positions, okay? Because what happens is the fact that the market makers can't fill in orders and take their profits without traders making orders for them. So what I mean by that is market makers have a lot of money and they need to either sell or they need to buy in order to sell and then short the stock and then make the money, right? So how does this come by? So what needs to happen is we need to gather a fair value to the market makers. And what that means is a fair value. If you look at here, what is a fair value to the market makers during this high to this low? So if we have this Fibonacci retracement, we know currently that equilibrium is the 50% mark, and anything below 50%, so the 62% range, is anything below this is a discount. So in today's market, what we know is that the market makers are really wanting to go by the optimal trading entry. So optimal trading entry, OTE, is this line for us. So for us, anything below this line is at a discount to us. So this is the optimum trading entry for us right now, because what we know is that price tends to consolidate and go below the optimal trading entry. So what does this mean for you guys? Well, this means that you guys are getting a discount on the market and the market makers are making this a fair value to them. So this bottom one is our optimal trading entry. Anything below this, you are getting an extreme discount. Okay. So what does this mean for the flip side? So when the market makers want to sell, where would they be looking to sell? Would it be down here? Or would it be the flip side, which is a premium? So a premium to the market makers is anything in between and above the premium market value, okay? So anything above this line on our Fibonacci. Because what we know right now is that the market makers, in essence, want to sell at a premium rate. So if we just drew a line in between what a premium position is, so we don't want to be getting in at this premium position. Why? Because the market makers are wanting to sell this off. And why do they want to sell this off? So that they can fill their orders and make a lot of money. So remember, fair valuation is at the bottom, our optimized trading entry. So this is our optimized trading entry. So anything below this line, we are in an extreme discount. So anything above this line is at a very, very high premium. And this is where we don't want to be. Why? Because the market makers are wanting to sell their stock. Okay? So, what I'm trying to give you guys in this lesson is the fact that we want to buy at fair value and we want to buy at a discount. Probably just like we did at the top, where it was an extreme premium. Down below here, we can do a line, and this, to me, would be our position of entry, right? So this would be our buy entry. Our buy entry would be this line, okay? So this line would be our buy entry, all right? And where would we put our stop loss? Well, we went to 31 and then we went to 19. So we would put our stop loss on this bottom line. Stop loss on our bottom line. And then what we would do is we would go to the nearest range point, okay, for our TP. And what's our nearest range point right now? Our nearest range point is right here. So, as you can see, our range point from a form of new high to consolidation is right here. So what would we be looking to do? We would be looking to buy here. We'd be looking for our stop loss not to be executed. And we would be targeting a point of interest followed by a consolidation period. From there, if we, hope you guys can see this well. From there, if we can get above our point of interest, we would then, so say if you had two contracts, we'd be looking to take one contract out at this line. So TP. And then a second contract at this line. And why? Because if we break our consolidation period, this is our take profit at premium value, okay? So remember guys, use your Fibonacci retracement. In the middle you have your 50%, which is your equilibrium. Below that we have a 62% line, and anything under that is fair value. However, today we're not using that. Why? Because from our lowest point to our highest point, we have had an optimal trading entry below the 78% range, right? And what our actual optimal trading entry is at a steep discount today, because we've come below this line and this is fair value to us, okay? So this is fair value. So we've got premium value, which the market makers want to sell off, because as of right now, there's people above this line or above these highs that have got buy orders to try and break new highs, and we spiral out, right? But what the market makers have is they have sell orders, because they've rallied the price up so that they can sell their massive shares off and take their profits, okay? So premium value versus fair value in today's market on today's time frame, okay? So That was just the London Exchange. And obviously I might make a video today of New York's exchange and what they consider as fair value and premium value. So anyway, guys, I hope you guys understand that. But your retracement, Fibonacci retracement, use that for the high of the day towards the low of the day. Find what is a fair value to yourselves and find what the premium value is not to buy in. Okay, and this should help you a lot. All right, guys, hopefully this made sense, and I'll catch you in the next video. Bye.